Welcome to Accounting 201 at Kapiolani Community College. In this video, we'll take a look at the parts of Chapter 4 that deal with worksheet and classified balance sheet. First of all, why do we want to use a worksheet? Well, the main thing is it speeds up preparation of your financial statements. As you'll see in the accounting cycle at the end of this chapter notes, the worksheet interjected in the process makes the accounting cycle speed up and financial statements get done more quickly. So how do you prepare a worksheet? First thing is you take your unadjusted trial balance and drop it into the debit and credit columns. So you have to remember your debit and credit rules to make sure that you're able to get that guy to come out okay. And next, you prepare adjusting journal entries by putting in dollar amounts in either the debit or the credit columns that are labeled adjustment. Debits on the left, credits on the right. If you need to add any additional accounts, you'll add those accounts below your unadjusted trial balance totals that are already there from your beginning trial balance. Then you carry over the amounts from the unadjusted trial balance through any adjustments to the adjusted trial balance. If you have a debit and it gets a debit balance account and it gets debited, then that account will get bigger. If you have a credit balance account and it gets credited, then that account would get bigger. And the opposite holds true for credits to debit balance accounts and debits to credit balance accounts. And almost never will you flip your balances over to a different column than whatever the original unadjusted balance was. So extend them across and get your financial statement amounts. So let's take a look at that here on the worksheet PowerPoint. Get your unadjusted trial balance, enter the adjustments, carry over to the adjusted trial balance, and then you have to split the trial balance into two, kind of almost arbitrarily. Revenues and expenses only go on the income statement. Everything else goes on the balance sheet. So that means what used to be a nice, concise, equal debit and credit trial balance is now split into two pieces. Let's take a look at it in a little bit more detail. Unadjusted trial balance, equal dollars of debits and credits. Drop in the adjustment amounts, and here's an example of primarily most of the kinds of adjusting entries you'd find in a worksheet. Carry them over to the adjusted trial balance. So this $2,500 of supplies getting credited will end up still being a debit balance in supplies, but lower. Whereas this salaries and wages expense getting debited will still be salaries and wages expense in the debit column, only bigger. Okay, carry it over here to the adjusted trial balance, and you see debits have to equal credits in both the adjustments as well as the adjusted trial balance. And then we carry them over and drop them into the income statement and balance sheet columns based on whether they're revenue and expense or something else. So to me, this kind of reminds me sort of this movie that I saw one time, and kind of like this guy here. Oh, my trial balance is not balanced anymore. Carry them over. You have unequal dollars of debits and credits. The unequal dollars of debits and credits means that there's a difference between the balances. That will equal either net income or net loss, and it should be the same difference on both sides. We drop in the difference between the credits and debits on the income statement or the debits and the credits on the balance sheet and put them in on the side that's the lower side in each pair, and then we'll have equal dollars at the very bottom here. So the line that gets labeled net income or net loss is this one with the difference here, $2,860 in this example. If it were a net loss, we would put the numbers in where the red arrow is, close to each other, because then the expenses would be larger than the revenue and the low side would be this credit side. So last little topic before we finish up this chapter. In a complete set of financial statements now, we're going to have to move from our baby kind balance sheet from chapter 1 to a more grown-up one like in chapter 4. In chapter 4, we're introduced to a classified balance sheet. Classified balance sheet is one that has multiple sections inside of it. So no longer is it okay to just have all the assets in one place and add them all up, and all the liabilities in one place and add them up. We now have subdivisions of those kinds of categories. You can see them shown here on this example, and here for the liabilities on this example, and your author's definition for what current items are. I prefer to think of current items as anything that moves a lot, kind of like currents in water. So the true test of them is, will the thing be the same thing likely in a year from now? If the answer is yes, then it's not current. It is non-current. If the answer is no, it won't be the same thing likely in a year from now, it won't be the same accounts receivable from the same customers, it won't be the same accounts payable to the same vendors, it won't be the same prepaid insurance for the same policy period, those things are current items. So if they turn over a lot, they're considered current. If they don't turn over a lot, they're considered non-current. So let's put this all together in terms of the accounting cycle and the worksheet. If you are able to interject the worksheet into the accounting cycle, you'll speed it up from having to do adjusting entries in a journal and post them to a ledger and do cross-referencing, then come back and make an adjusted trial balance, and then finally make your financial statements, to just getting the worksheet, getting the amounts that you need on the financial statements, getting them done, getting them to management, and answering any questions they have. And the rest of this stuff, items 7 through 10, management is usually not concerned about, because that's kind of like your cleanup work. You do have to put the adjusting entries in the journal. You do have to post them to the ledger. You just no longer have to do that before preparing the financial statements. Hope this helped with Accounting 201 Chapter 4.